Hey guys, welcome back. Three traders, $10,000 each. One finishes up nearly 3,000, one loses half. Here is the method. Before anything else, here is the promise. This is the real Apple chart from the last 2 months, and if it looks like noise to you, that is exactly why this course exists. By the end, you will read this like a trained eye. You will spot the shelf where buyers kept defending and the ceiling pressing down on it. You will catch the breakout, the day that ceiling finally snapped. You will see the staircase the trend builds on the way up, a rising low, then another, then a third. And you will respect the warning wick, the candle where buyers charged to a record high and sellers slammed it all back. After that warning, this slide surprised nobody who could read it. 12 skills, 3 traders, 1 language. By the final chapter, you will write a complete trade plan on a chart exactly like this one. Here's the whole journey on one map in 3 stages. Stage 1. You learn to read the chart. It starts with one single candle, then timeframes, the zoom level of the story, then trends and market structure, then support and resistance, the floors and the ceilings, and then trend lines and channels. Stage 2, you learn to find signals, candle patterns, the shapes 1 or 2 candles make, chart patterns, the bigger shapes, moving averages, the trend made visible, and volume, the lie detector. Stage 3, you learn to trade like a professional, risk and position sizing, the chapter that keeps you alive, order types, how you actually get filled, and the trading plan, where every skill clicks into one routine. 3 traders are about to walk this exact road with real money. Let's meet them. From here on, 3 traders take every single one of these charts, each starting with $10,000. This is Mike. He does exactly what each lesson says. Nothing more, nothing less every time. This is Jake. Rules are for other people. He chases what is moving. He doubles down when he is wrong, and he has never once set a stop. And this is Tom. He knows every rule and trusts none of them until it is too late. He is always late. Same charts, same money. Keep your eye on the gap that opens between these 3 curves. Chapter 1. We start with the smallest thing on any chart, one single candle, because the candle nearly always speaks first. This is Broadcom this spring, climbing hard for 2 straight weeks. Everyone is brave, everyone is chasing. Now look at this candle. In the morning, buyers push the stock to a brand new high. By the close, sellers have slammed every dollar of that push right back down. All that survives is a long upper tail, a battle report that says the buyers charged and the buyers lost. 3 days later the stock has bled 6% and the crowd is stunned, but nobody rang a bell at the top. The candle was the bell. Let me teach you to read every part of it. Here is the whole skill on a clean board in 4 steps. Master these and every chart starts talking to you. First, the facts. Every candle records exactly 4 prices, where the candle opens, the highest price anyone paid while it was alive, the high, the lowest price anyone accepted, the low, and where it finishes, the close. Open, high, low, close. 4 facts, 1 little drawing, and that is the entire vocabulary. Second, the body. The thick block between the open and the close. The body is conviction. A tall green body means buyers ran the session from start to finish and never gave it back. A tall red body means sellers owned the day. And a tiny body means stalemate, a fight where nobody won, which is information too. Third, the wicks. The thin lines above and below the body. A wick is a place price visited and got rejected. A long tail under the body means sellers forced price down and buyers slammed it straight back. That is a defense. A long tail above the body means buyers charged and got crushed. That is the exact warning you just watched on Broadcom. Fourth, location. This is the part most beginners never learn. The same candle is a completely different signal depending on where it prints. A rejection tail floating in the middle of nowhere is noise, skip it. That same tail landing on a floor the market has defended for weeks is a signal worth real money. Location first, candle second, always, open, high, low, close. Body for conviction, wicks for rejection, location for meaning. Now let's put real money on it. Now the real thing, this is Apple earlier this spring, 50 days on one chart, and 3 traders are about to read it 3 very different ways. Start with the structure. Back in February, Apple topped out just above 276. From there, the slide, week after week of red, 11% down. But look what happens near the bottom. Price keeps stopping at the same floor again and again, never closing below it. Remember that floor. Then the first bounce. A strong green day pushes all the way back up, and a big green candle is all the invitation Jake ever needs. He buys the very top of it, all in, no stop. It's finally taking off, he says. The next morning is the lesson. Price collapses, $8 straight down, right into the floor. Jake can't take it. He dumps everything into the crash within $1 of the very bottom. But now freeze the chart and read the candle that day actually printed. Sellers drove price $8 deep, and buyers took back every single cent before the close. A small body at the top, a giant tail below, and the low landing almost to the penny on that old floor. That is a hammer, a rejection, a defense, a war the sellers just lost. Mike reads it in 10 seconds. He buys the close, his stop goes just under the floor, where the hammer's story would be proven wrong, and his target sits back at the February ceiling. He risks 1% of his account, $100, not a cent more. Tom always sees it. He saw the hammer the moment it printed. But a hammer is not confirmation, so Tom sits on his hands and waits. Watch what the floor does next. The bounce holds, and day after day the lows stay above the hammer's tail. A week later a big green candle clears the rejection high. And that, finally, is enough for Tom. He buys at full price, with a whole dollar of the move already spent. From there the chart does the rest. Price grinds higher, never once threatening Mike's stop. And on the 1st of May, Apple gaps up and tags the February ceiling. Target hit. Mike collects 2.5 times what he risked. Tom squeezes out a few crumbs for the same idea, and Jake sold the exact bottom of a move he was right about. The chart he predicted paid everyone but him. One candle, read properly, paid Mike $250. Reading it wrong cost Jake $540. That gap is this entire course, and it only gets wider from here. Next, the zoom level, because the same candle tells a different story on every time frame. Chapter 2. Timeframes. Before you trust anything a candle tells you, you have to know which clock it lives on. This is Google, 1 stock, 3 clocks, all photographed this very week. The weekly chart, where every candle is a full week, has been climbing for 9 straight months. Calm, healthy stare after stare. Now the daily chart, just the last 2 months. And suddenly it looks ugly, a slide that has been running for 2 weeks. And the hourly chart this week alone is a wall of red panic. Same stock, same moment. 3 different answers. So which clock is lying? None of them. Each one answers a different question. And the smaller the clock, the louder it shouts. The mistake that drains beginner accounts is letting the loudest clock make the decision. The bigger clock outranks it, and the rest of this chapter shows you exactly how to use that. 4 steps to make every clock work for you instead of against you. First, the nesting. Every candle is a box of time, and the boxes nest. One weekly candle contains 5 daily candles, and each daily candle contains the whole trading day of hourly ones. Nothing magical changes between views. You are just zooming the same story. Second, the tide. The bigger clock is the tide underneath, the smaller clock is the waves on top. Waves can splash in any direction, but they all ride the tide. When the weekly is rising, a scary red day is usually just a wave. Third, your pair. You only need 2 clocks, a big one to make the decision, and a small one to time the entry. Daily plus hourly for faster traders, weekly plus daily for calmer ones. Pick a pair and keep it. Fourth, the agreement rule. You act only when both clocks point the same way. Big clock up, small clock turning up. That is a green light. When they argue, you do not pick a side, you wait. The market pays patience, not referees. Nesting tide, pair, agreement. Now watch what happens to 3 traders who meet a chart where the clocks disagree. Now the real thing, Qualcomm, late last year, and this time the clocks are the whole story. The big clock first. For weeks this chart has been walking downstairs, lower high after lower high, lower low after lower low. That is the tide, and the tide points down. Then comes the bounce everyone wants to believe. 4 green days straight up, and on the small clock this looks like the bottom. Jake is already in, all in, no stop, buying the top of the bounce. He never once looked at the bigger clock, but look where that bounce dies, right under the last lower high. The staircase is intact, and days later the market shows you whose side time is on. Price knifes through the whole bounce, down to a brand new low. The tide wins. Jake rides it all the way down and dumps it all near the very bottom. $950 gone. His second loss in 2 chapters, and right here, the patient money starts paying attention. Look what price does at that new low. It stops falling. Day after day it holds the same floor, and the bounce tops flattens into a little ceiling overhead. The waves are losing their push. Then it happens. The first close above the little ceiling. The small clock has turned up, and the big clock has stopped saying down. Both clocks finally agree, and that is Mike's entire signal. He buys the close, puts his stop under the whole base. If price sinks back in there, the turn was fake, and targets the last lower high, the shelf every seller remembers. 1% risked, as always. Tom watches the same breakout and wants more proof. A strong green day finally convinces him. That, at last, is enough for Tom. Full price again. From there the waves ride the new tide. And 12 days after the turn, Qualcomm tags the old ceiling. Target hit, almost to the cent. Mike banks 1.5 times his risk. Tom keeps his crumbs. Jake fought the tide and paid for it again. Same candles for everyone. The only edge was asking the bigger clock before trusting the smaller one. Next up, the staircase itself. Trends and market structure. The pattern you just watched made precise. 2 chapters in, the gap is already real. Mike is up about 400 from 2 clean reads, a hammer on a floor, then a base where the clocks agreed. Tom has scraped a couple of hundred, and Jake has burned nearly $1,500 fighting 2 perfectly readable charts. Watch what the staircase does to him next. Chapter 3, Trends and Market Structure. Zoom out far enough and every healthy chart stops being noise and becomes a staircase. This is Goldman Sachs this spring. Watch the lows, every single dip stops higher than the dip before it, and watch the highs. Every push reaches higher than the push before it. Higher lows, higher highs, that is the entire definition of an uptrend. Nothing more mystical than stairs, and here is why it pays in a staircase. The expensive-looking spot keeps becoming the cheap spot of the next stair. People who guess the top fight the stairs. People who buy the dips ride them. Let me give you the exact rules. The whole skill, 4 steps, 1 ruler. First, the swings. Price never moves in a straight line. It breathes, pushes up, rests down. So mark every peak it makes and every valley it leaves behind and ignore everything in between. Those swing points are the only honest skeleton a chart has. Second, the stairs up. An uptrend is just this, every peak higher than the last peak and higher lows underneath them. As long as the stairs keep stacking, buyers are in control and dips are for buying, not fearing. Third, the mirror. Flip it upside down and you have a downtrend, lower highs, lower lows. The same staircase, descending. In that world, every bounce is a selling chance and bottom guessing is donating. Fourth, the break. The staircase rules until price takes out the last higher low. That single break does not promise a crash. It means the structure is in question and your edge is gone. No stairs, no trade. Stand aside until a new staircase forms. Swings, stairs, mirror, break. Now let's see what the staircase pays and what fighting it costs. Now the staircase with money on it. This is Netflix this spring, and for the first half of this chart there is nothing to do. Price chops sideways, overlapping swings, no stairs anywhere. That is not a bad chart, it is just noise, and noise is a no-trade zone. Then watch the bottom form. One final flush in late March, and the next dip bottoms higher, a higher valley. Then price pushes up and prints a higher peak. Valley up, peak up, the staircase has begun. That strong push is exactly where Jake smells a top. It has gone up too fast, he says, so he shorts it all in, no stop, betting against a staircase that has just announced itself. And for 2 days, Jake looks like a genius. Price eases off, and then the dip stops, right where a staircase says it should, above the old valley, a brand new higher low. Mike has been waiting for exactly this. When the dip's little high breaks, Mike buys the stair. His stop goes under the new higher low. If that level fails, the staircase is broken and he wants out instantly. His target sits beyond the old peak, because healthy staircases keep making new peaks. 1% risk as always. Next come 3 quiet green days. Tom needs every one of them. That at last is enough for Tom. Full price as usual. Then comes the candle that settles everything. One big green day rips through the target. And the same candle that pays Mike 1.5 times his risk leaves Jake trapped under a market that simply will not come back. 2 more stairs and Jake finally surrenders, covering at the very top of the chart. $760 lighter on a trade where the structure was against him from the first minute. Mike was paid for trading with the stairs, and his stop was never once in danger. The staircase defended it the whole way. Tom collected pocket change, and Jake learned the most expensive sentence in trading: it has gone up too much. Next chapter, we meet the places where staircases love to pause and turn: floors and ceilings, support and resistance. Chapter 4, Support and Resistance. Floors and ceilings, the handful of prices where the market keeps changing its mind. This is Amazon last fall. Watch the same ceiling work over and over. Early September, the sellers held the line. Days later, then again, and one more time after that. The shelf is real. Then earnings hit and price blasts through that shelf without even pausing. Now watch the part that matters. A week later, price falls all the way back to the exact shelf that rejected it 3 times, and the shelf catches it like a floor. The ceiling changed jobs. That is the roll flip, and it is the most useful habit a level has. One more thing, and it should give you chills. That chart is from last fall. This very week, months later, Amazon is trading right back at that same shelf. Good levels do not expire. Let me give you the rules. 4 rules turn random lines into real levels. First, the turning points. A level is not a magic number. It is simply a price where the market turned before. Find the spot where price reversed hard, draw a horizontal line through it, and you have a candidate. Second, the touches. 1 turn could be an accident. 2 is interesting. When price comes back yet again and the same line holds, that level is real, and it grows stronger with every extra touch that never closes beyond it. Third, the flip. When a real ceiling finally breaks, It does not vanish. It changes jobs. Old ceilings become new floors. Old floors become new ceilings. The retest of a freshly flipped level is one of the cleanest setups in all of trading. Fourth, the edges. The money lives at the edges of the range. You buy at the floor with your stop just beneath it, and you take profit into the ceiling. The middle of the range is no man's land. No level near you, no edge, no trade. Turning points, touches the flip, the edges. 3 traders, 1 range, watch who respects the middle. Now the range with money on it. This is ServiceNow last fall. And unlike the staircase from last chapter, this market is going nowhere. Price is locked in a box, and a box has exactly 2 places worth your attention. The ceiling overhead. Every rally into the mid-190s gets sold, and down below the floor zone, a floor that began life as an August ceiling, the exact roll flip you just met. Watch it work. Early September, price drops into the zone and holds it. A month later, back again, holds again. The level is real, the box is real. Mid-October, a big green day pops in the middle of the box, far from both levels. And that is all Jake needs. He buys the middle, no level above him, no level beneath him, just motion. For 2 days nothing happens because mid-range air has no opinion. Then price slides back toward the floor, and Jake's nerve slides with it. At the bottom of the slide he panic sells, straight into the floor zone. And here is the lesson the market hands out for free. Jake sells at the very same price on the very same day where Mike's resting order buys. 1 price, 2 traders, opposite directions. And the only difference is that Mike knew the level was there. The floor holds for the 3rd time in 2 months, and Mike is in. His stop sits beneath the floor zone. If the floor truly fails, he is out for pennies. His target sits just under the ceiling, because edges are where profits get taken. 3 green days later the bounce is obvious, and that, at last, is enough for Tom. He pays $188 for what Mike bought at $179, then sits through a red week with no room to breathe. Then earnings night arrives and resolves the range. Price surges into the ceiling, tags the target, and Mike collects almost 3 times what he risked. His stop never once threatened. Tom's reward for all that waiting about $50, and Jake donated $245 to learn that the middle of a box pays nobody. Floors, ceilings, and the no man's land between them. That is the whole geography. Next up, floors that slope. Trend lines and channels, the diagonal floors of a trending market. Chapter 5, Trend Lines and Channels. You have met flat floors. Now meet the floor that climbs. This is AMD through the winter. 1 dip stops here. Weeks later, the next dip stops higher, and a dip later still, higher once more. 3 lows, 1 straight line. A rising floor. Buyers are not waiting at a price anymore. They are waiting on a schedule. And the last touch is the famous one. The line holds to the cent, and the bounce runs $30 in a handful of days. A sloped floor, drawn through real lows, never forced. That is the entire idea. Let me show you how to draw one honestly. 4 steps to lines that tell the truth. First, the proof. Any 2 rising lows give you a candidate line, nothing more. The 3rd touch makes it real. Until a line has its proof, you draw it lightly and you risk nothing on it. Second, draw it honestly. A real line touches real lows. If your line slices through candle bodies to fit your opinion, it is not a trend line, it is a wish. Never force it. No honest line on the chart means no line at all, and that is information too. Third, the channel. Clone your floor line and float the copy up to the highs, a parallel rail. Trending markets often walk this corridor for weeks, bouncing from line to rail and back. The rail is where profits get taken. Fourth, trading the line. Buy the touch when the line has its proof. Your stop goes under the line, small, immediate, honest. Your target is the rail. And the day a candle closes below a proven line, the corridor is over. Stand aside and wait for the next one. Proof, honesty, the channel, the touch. Now watch a corridor pay 3 traders 3 very different ways, including, for once, Jake. Now the sloped floor with money on it. And a chapter where Jake finally wins, which is exactly the problem. This is Snowflake last summer. The line is born at the June low. Days later, price touches again, a little higher. 2 points, a candidate. Then for weeks, nothing to do but wait. And in mid-July, price lands on the line right on schedule. 3 touches, 0 violations. The line has its proof. Mike buys the touch the moment the bounce closes strong. His stop goes under the line. If a floor this proven snaps, he wants out instantly. And his target is not a guess. Clone the floor to the highs and you get a parallel rail. Price has respected that rail all summer, so he aims just under the rail. Watch the corridor work. 2 days later, price dips, kisses the line one more time and holds. 4 touches now. That big green recovery day is finally enough for Tom, who pays full price for a line Mike bought $4 cheaper. Then a breakout candle pops near the top of the corridor, and Jake chases it. No line, no level, no stop. Pure motion, and this time it works. Price climbs the corridor stair by stair, and at the end of the month the rally tags the rail. Mike's target, 2.5 weeks of patience for $225. his 5th clean win in 5 chapters, and the same rally means luck pays him too. Jake walks away with $315, his biggest day of the course. So yes, Jake beat Mike this chapter. Let that sink in because that win is the most expensive thing Jake owns. It just taught him that chasing works, right before the chapters where that lesson costs him everything. Luck pays first and collects later. The floor line through real lows, the rail above it, the touch, the corridor. And when a candle closes below a proven line, the corridor is over, stand aside. Next, the small shapes candles make in 2s and 3s, candle patterns, the signals that fire right at lines like these. And that closes Act 1. You can now read a chart: candles, clocks, structure, levels, lines. The scoreboard after 5 patient reads. Mike is up $1,100 without one scary moment. Tom is up around $400, always a week late, and Jake is still down more than $2,000, but he just banked his first win, so he is certain the comeback has begun. Act 2 is where we stop just reading and start hunting for signals. And the first signal chapter is the one that fires right at the levels you just learned to draw. Chapter 6, Candle Patterns. In Chapter 1 you learn to read one candle. Now candles start talking in sentences, but only at the right address. This is Broadcom in the fall. Mid-September, mid-slide, prints a perfect doji, tiny body, long wicks, the textbook picture of indecision. And it means nothing, the slide just continues, because nobody important was defending that price. 2 weeks later, the same grammar appears at an address that matters. Price has found a floor the market keeps defending, and right there a green candle swallows the whole red candle before it, a bullish engulfing at a floor. That one pays nearly 3 to 1. Same wick logic, opposite outcomes. Location loads the gun. The pattern only pulls the trigger. Location first, pattern second. Let me show you the 4 shapes worth knowing. 4 shapes, 1 address rule. First, the shapes. A hammer, a long tail below, sellers attacked and got crushed. A shooting star, the mirror image, a long wick above, buyers attacked and got crushed. A doji, a tie, nobody won, and the engulfing. One candle swallows the body before it. A takeover. Second, the meaning. Notice there is nothing mystical here. Every pattern answers the same question you learned in Chapter 1: who attacked, who won, and how decisively. The names are just shorthand for battles. Third, the address rule. A pattern floating in no man's land is noise. Skip it, no matter how pretty. The same pattern printing at a defended floor, a ceiling, or a trend line is a signal, because there you know exactly who was fighting and what they were defending. Fourth, confirm it and draw the line in the sand. You trade the pattern's close, not your hope, and the pattern's own low is your stop. If price takes that out, the battle story was false and you leave for pennies. Shapes, meaning the address, the stop. Now to a chart where one pattern paid a reader, and another punished a label collector 6 days ago. Now the patterns with money on them. On Tesla, and this chart runs right up to yesterday. The month opened at the April high, then bled lower for 2 weeks. But look where the bleeding kept stopping. A shelf of buyers in the mid-360s, tested and tested, and the market kept refusing to close below it. Then, at that exact address, the sentence completes. One more red day, and the next candle swallows that red body whole. A bullish engulfing, sitting right on the shelf, the takeover candle, at a defended floor. Mike trades the close the moment the pattern is finished. His stop is the pattern low, the line in the sand from the playbook, and his target is the April high above. The bounce builds. A big green day midweek is finally enough for Tom. Full price, 1 day before the top of that leg as ever, and a week of patience after the pattern price rips through the April high. The address plus the pattern paid Mike again. Now fast forward to last week. This actually happened 6 days ago. Tesla floats up to 418 and prints a beautiful doji. Textbook shape. Tiny body, clean wicks. But look at the address: miles from any level, midair, no shelf, no line, nothing anyone is defending. Jake buys the label. Doji means reversal, he read somewhere, and the lucky win from last chapter told him his instincts are sharp now. No stop, of course. The very next bar, Tesla falls 30 points, no defense, because there was nothing there to defend. Jake dumps it into the close. $515, the entire lucky win handed straight back with interest. A pattern is a sentence. The address is what makes it true. And next chapter the sentences get bigger. Chart patterns, the shapes whole crowds make over weeks. Chapter 7, Chart Patterns. Single candles speak, whole crowds write shapes. This is CrowdStrike last fall drawing the most famous shape of all. A hard sell-off carves the first valley. Buyers push back up to a relief hill. Then fear returns and carves the second valley, which holds almost exactly where the first one did. 2 floors at one price. The sellers tried twice and failed twice. But the letter only completes when price closes back above the hill. And once it does, the chart owes you a target, the depth of those valleys, projected up from the hill. Price walks straight to it inside 3 weeks. Fear, relief, fear again, then proof. That is a double bottom, now the rules, and then a W that finished printing 8 weeks ago. The crowd's handwriting in 4 steps. First, the W itself. Fear carves a valley, relief builds a hill, fear returns, and the same floor holds. That second hold is the message the sellers emptied their pockets at that price once and could not do it again. Second, the mirror. Flip the W upside down and you get the M. Greed pushes to a ceiling, doubt pulls back, greed pushes again and fails at the same ceiling. A double top. One piece of logic both directions. Third, the neckline rule. Half a pattern is a guess, and guesses are how accounts die. There is no trade, none, until a daily close lands beyond the hill line. Before the close, gambling. After the close, trading. Fourth, the measured move. The pattern carries its own target. Take the depth of the valleys and project it from the hill line, and the stop is halfway back inside the pattern. If price sinks that deep, the proof has failed and you leave. The W, the mirror, the proof, the projection. Now a W that real money fought over 8 weeks ago. Now the W with money on it. This is Texas Instruments this spring. The slide into March is brutal, 17% off the February high, and it ends in a hard first valley. Then a bounce of buyers push price up to a hill of relief, and Jake has been waiting to buy this dip the whole way down. The bounce looks like the turn, so he buys it, because it is cheap. That is the entire plan. Fear comes back. Price rolls over and slides all the way down again, and Jake cannot stomach the second trip. He sells into the second valley, 4% poorer. On the very day the chart prints its second floor, 5 cents from the first. The W is half built, and Jake just paid the tuition. Mike sees the same 2 valleys and the same hill. But a half-built pattern is a guess, so the playbook says wait no trade until a daily close above the hill line. A week later it prints. The close that counts, 20 cents over the line. Mike is in at the close. His stop sits halfway back into the pattern. If price sinks that deep, the proof has failed. His target is not hope. Take the depth of those valleys and project it up. The same depth, the measured move. The next day gaps higher. And that, at last, is enough for Tom. 2 closes after the proof, $10 above Mike. 1 day more and the measured move pays in full. 3 days, start to finish for the trader who waited 7. The W pays patience twice, once for skipping the half-built guess, once for the proof, and Jake has now sold the exact bottom of the 2 most famous shapes in charting. Next up, the line that follows the trend for you, automatically, moving averages. Quick scoreboard, mid-act 2. Mike has banked 7 straight disciplined wins, almost $1,500 of pure process. Tom keeps collecting his crumbs and Jake is down nearly $3,000, having now sold the exact bottom twice in 2 chapters. Next chapter matters for him most of all, because the tool it teaches would have saved him every single time. Chapter 8, Moving Averages. Everything so far you had to see for yourself. This tool sees it for you. This is Nvidia last summer. That smooth line under price is a moving average. The average of the last 50 closes, redrawn every day. Nothing more. But watch what it does. Mid-September, the dip lands on that rising line and then price rides it for days, kissing it again and again, once to the penny, before the bounce that follows carries it back toward the highs. The staircase from Chapter 3, drawn for you, moving support, and the slow dashed line far beneath everything. The 200-day, the tide itself. Above a rising 200, dips are for buying, below a falling one, bounces are for selling. That single sentence retires half of all beginner mistakes, including the one Jake is about to make. The speeds, then the money. 3 speeds, 1 tide. First, what the line is. Take the last 50 closes, average them, plot the dot, and tomorrow, drop the oldest close, add the newest, and re-average. That is the whole machine. The line is smooth because it forgets slowly. Second, the speeds. The 20-day is the sprint. It hugs price and turns fast. The 50-day is the swing, the rhythm of the move. And the 200-day is the tide. Slow, heavy, and the single most watched line in all of markets. Same math, 3 different memories. Third, moving support. In a healthy trend, pullbacks kiss the rising average and bounce. A floor that climbs with the trend, the staircase automated. The kiss of a rising 50 is one of the most reliable dip buys in trading. Fourth, the tide rule. Above a rising 200, dips are for buying, and shorting is fighting the tide with your account as the paddle. Below a falling 200, bounces are for selling and knives are for not catching. Pick the side of the tide every time. The machine, the speeds, the kiss, the tide. Now watch the tide rule pay one trader and fine another. Now the averages with money on them. This is Microsoft last fall, climbing along its rising 50 all season, with the 200-day far beneath it, rising too. The tide is up, and it has been up all fall. In mid-October comes exactly the dip the playbook describes. Price pierces the rising 50 by less than 1% for a single session, and 2 days later it closes back above the line. That reclaim is Mike's entire signal, the kiss of the 50 in a rising tide. He buys the close, puts his stop just under the average. If a rising floor this strong truly fails, the pullback is something bigger, and targets the prior high overhead. 3 green sessions later the bounce is undeniable, and that, as always, is finally enough for Tom. But the same week Jake smells excess. Microsoft is 13% above its 200-day, and to Jake that reads as gravity owed. So he shorts it, above a rising 200, against everything the tide rule just said, with no stop. He is not shorting Microsoft, he is fighting the tide with his account as the paddle. The next week settles both trades. Price glides up the 50 and tags the prior high. The kiss pays Mike 2.3 times his risk textbook, and the morning after, earnings gap the stock $24 higher. Jake surrenders into the gap at the open, $325 paid to the tide he refused to respect. The tide sent the bill overnight. Buy the kiss of a rising average, never short above a rising 200. The lines are not magic, they are the crowd's memory, and the crowd defends its memory. Next, the lie detector. Volume, the chapter that tells you which breakouts are real. Chapter 9, Volume, the lie detector. Every candle so far told you what price did. The strip underneath tells you how many people meant it. This is meta this winter, and the same ceiling gets tested twice. In late January, price pushes through on twice normal volume, the crowd showed up, and the move is paid in a day, gapping 50 points the next morning. 2 weeks later, price pokes over the very same ceiling, on half its normal volume, an empty room. No crowd, no conviction, nobody behind it, and the poke collapses within 3 sessions, taking everyone who believed it down 4%, same line. 2 breakouts. The only difference was the strip at the bottom, and it told you in advance. Price says what happened, volume says whether to believe it. Loud moves are real, quiet moves lie. Let me give you the rules. The turnout tells the truth in 4 steps. First, what the strip is. Every bar at the bottom counts how many shares changed hands that day. Think of price as the vote and volume as the turnout. A vote with no turnout decides nothing. Second, conviction confirms. When a real breakout happens, the crowd is in the room, the candle pushes through and the volume bar towers over its neighbors together on the same day. That pairing is what conviction looks like on a chart. Third, the quiet lie. A push to new highs on thin volume has nobody behind it. The candle looks identical to the real thing. That is exactly why it fools people. But the room is empty, and empty rooms do not hold prices up. Fourth, the measuring habit. Never eyeball it. Compare today's bar to the average of the last 20. Roughly double or more. Listen. Below normal on a supposed breakout, suspect it by default, no matter how good the candle looks. The vote, the crowd, the empty room, the measurement. Now the chapter where the smartest trade is the one Mike refuses to take. Now the lie detector with money on it. This is Uber last fall, one ceiling, and the market will test it 3 times. Watch the strip at the bottom as much as the candles. The ceiling sits just above 97, and price has rejected it before. In mid-September comes attempt 1, a close over the line. But the strip shows barely above normal turnout. A mumble, not a statement. And sure enough, it fades straight back under within 2 sessions. Not heavy enough is still a lie. 4 days later, attempt 2, and this one is a roar. Price closes over the ceiling while the volume bar towers over everything near it, more than double the average. The crowd is in the room. Mike buys the loud close, stop back under the level, target at the measured move above. 1 trading day later, the target is hit. When volume confirms, breakouts pay fast. Now October. Price drifts back to the same ceiling and pokes over it one more time. Attempt 3. The candle looks fine, but the strip shows half the usual turnout, a whisper. Mike measures it and refuses the trade, flat, on purpose. Skipping is also a trade. Jake sees the same candle and buys the whisper. No measurement, no stop. 2 sessions later the empty room empties further and he is out, $270 lighter. His 5th straight chapter paying tuition. Tom hesitated on everything, and for once it saves him completely flat, intact, untouched. And the trade he refused is the whole lesson. Mike made money on the roar and lost nothing on the whisper, because volume told him which was which, in advance, both times. That closes Act 2. Next comes the act that decides who survives risk. And that is Act 2 complete. The scoreboard, after 9 disciplined trades, Mike is up nearly $2,000, and he never once risked more than 100 at a time. Tom is up 600, the world's most careful spectator, and Jake has now paid 5 chapters in a row straight to the market, down more than 3,500. Act 3 is where accounts live or die. First lesson, the one chapter that would have saved Jake from everything, risk, and the 1% rule. Act 3. Everything so far taught you how to find trades. This act teaches you how to survive them, starting with the one number that decides whether a losing trade is a paper cut or a funeral. This is Netflix, from October to today. A floor forms just above 108 and holds for weeks. In mid-November comes a textbook buy signal, a bullish engulfing right on that floor. Everything Act 2 taught you says yes. The very next day the trade fails. Then the floor gives way, and the stock just keeps falling, all the way to 76 by late February. It trades near 81 today. Every trader who bought that signal took the same loss per share, but one of them lost about 1% of his account, and one of them nearly lost the account. Same chart, same entry, same stop out. The difference was position size. That is Chapter 10. Risk is a number, not a feeling. 4 steps. First, the distance. Before you buy anything, measure the gap between your entry and your stop in dollars per share. That gap is what one share can lose you, the only honest price of the trade. Second, the survival rule. Decide what 1% of your account is. On a $10,000 account, that is $100. And make that the most any single trade is allowed to take from you, not the position. The loss. Third, the size formula. Divide your risk budget by the distance. $100 of budget, $4 of distance, 25 shares. The formula sizes every position for you, so you never have to guess again. Fourth, think in R1. R is simply the amount you risk. A disciplined loss is -1 R, never more. And drawdowns are not symmetric. Lose half the account, and you must double what is left just to get even. Small losses are the whole secret. The distance, the budget, the formula, and R. Now watch one losing trade hit all 3 traders at very different prices. Now the same losing trade, taken 3 ways. Netflix again, October to early December. The weeks you just saw up close. The floor first just above 108, tested over and over for 3 weeks. One deep wick pokes under it in early November, and buyers slam it shut the same day. The floor is real. Mid-November, the signal, a wide green candle, engulfs the previous day and closes strong, right off the floor. Entry at the close. Stop just under the floor. Target back at the October high. The distance comes to $5.44 per share. Mike does the math first. 1% of his account is about $120, so the formula gives him 22 shares. Tom, terrified as always, buys 2. Jake skips the math entirely, puts nearly his whole account in, 50 shares, and sets no stop, because stops are for cowards. The very next morning the floor cracks, price slices 4 cents through the stop, and Mike and Tom are out, instantly, automatically. Mike pays $120, -1 R, exactly the price he agreed to in advance. Tom pays $11. Jake has no stop. The floor collapses for good the next day, and he finally sells into the third red morning. $490 gone, almost a tenth of what he has left. And here is what you must never forget: the signal was good, and the trade still lost. You already saw where Netflix went from there. Mike's stop was not a cost. It was the cheapest insurance he will ever buy. Next up, getting in and out without handing money away. Order types. You now know what to trade and how much. This chapter is about how you actually get in and out, because the same trade can come with 3 different bills. This is Goldman Sachs this winter, a ceiling at 919, and in early January price smashes through it on heavy volume. Jake wants in immediately, so he sends a market order, buy now, pay whatever anyone asks, and gets filled near the very top. Mike wants the same stock, but he refuses to chase. He parks a limit order down at the old ceiling, his chosen price, and waits. 9 days later the market comes back, touches his price, and fills him. The very next day the stock explodes to new highs. And look at the same bar that filled Mike. That is Jake giving up. Same stock, same week, 3 different bills. How orders work, and which one to send when, is Chapter 11. 3 orders, 1 plan. Here are the only tools you need. First, the market order. It says, fill me now at whatever the ask is. You get speed, and you pay for speed. In a fast move, the fill lands at the worst price of the day. Use it only when getting out matters more than the price. Second, the limit order. It says fill me at my price or better, or not at all. You park it at your level, walk away, and let the market come to you. Patience, written as an order. Third, the stop order. It sleeps below your entry and fires itself the moment price touches it, becoming a market order that takes you out automatically. It is the seatbelt from the last chapter. No hesitation, no debate, no watching the screen. And fourth, the bracket. The whole plan. Sent as orders before emotion shows up: a limit to get in at your level, a stop below it, a target limit above. Set it, then walk away. The speed tool, the patience tool, the seatbelt, and the bracket. Now watch what each one costs on a real chart. Now the full story, slowly. Goldman Sachs, December into January. In mid-December the stock touches 919.10 to the cent and gets rejected hard, straight back down to the high 860s. That exact high is now the line everyone is watching. Through late December, price creeps back toward it. Then, in the first week of January, the breakout price smashes through the ceiling on heavy volume, 1.8 times normal, and runs to 961 in 2 days. The move is real. The crowd is in it. Jake cannot stand missing it. He sends a market order into the excitement and pays the top tick, 958. No stop, no target, just the fear of being left out. Mike wants the same stock and refuses to chase. He knows broken ceilings get retested, so he parks a limit order at 919.10, the old ceiling, with a stop underneath at 908, and a target at the chase high. Then he closes the laptop. 9 days later, the retest arrives. Price sinks back and touches 917.90 and fills his limit at 919.10. And on that very same bar, Jake, who has watched his chase bleed for a week, sells in disgust, 4% below his entry. Look at the exact price where Jake quit. It is where Mike got paid to start. Tom also wanted a limit order, but he got greedy and set it at 910 instead, hoping for an extra few dollars. The retest stopped at 917.90. His fill never comes. No loss, no win, no trade. A limit at the wrong price is just a spectator's ticket. The next day, the stock blasts to new highs, 981, and Mike's target prints, plus 3.86 R, $435 for refusing to hurry. One chapter left, the whole plan start to finish. Look at the board with one chapter to go. Mike took his only loss in chapter 10, and it cost him exactly the size he chose in advance. Then his limit order got paid to wait. He sits near 12,250. Tom is flat where he was, the man whose orders never fill. And Jake is down to 5,695, still convinced the next chase will fix everything. Every skill is on the table now. The final chapter puts them together into one plan and settles the scoreboard for good. The final chapter. And everything you have learned is about to happen on one chart at the same time. This is Shopify last summer. The trend is up, higher highs, higher lows, all spring. A flat ceiling sits just under 119. Tested again and again and never broken. Then one July candle engulfs the day before and closes straight through the ceiling, and the strip confirms it, nearly double the usual turnout. A week later the old ceiling is retested, and it holds as brand new support. The measured move projects 133. Trend level, signal, volume, structure. When everything you know points the same way at the same moment, traders call it confluence. It is the highest probability picture a chart can show you. Trading it with a written plan is chapter 12, the one where the scoreboard gets settled for good. The trading plan in 4 steps. The routine that replaces guessing. First, the checklist. Before any trade, 4 questions. Is the trend on my side? Am I at a level that matters? Did a signal fire there? Does volume back it up? 4 yeses or no trade. And 3 out of 4 is a pass, not a trade. Second, the numbers. Write the entry, the stop, and the target before you click anything. The formula from chapter 10 sizes the position, and the reward must be at least twice the risk, otherwise the math quietly works against you. Third, the bracket. Send the whole plan as orders, a limit at your level, the stop underneath, the target above. Once it is working, your job is to do nothing. Fourth, the journal. After every trade, win or lose, write down the setup, what you did, and what you felt. The journal is where mistakes go to die. Without it, you repeat them forever. Checklist, numbers, bracket, journal. Now the final scoreboard. 3 traders on the last trade of the course. Shopify, June and July. Run the plan with Mike step by step. The checklist: first, trend, higher highs and higher lows since spring, yes. Level, a flat ceiling just under 119, tested 5 separate times and never broken, yes. This level matters. Signal, in mid-July, a wide green candle engulfs the day before and closes through the ceiling, yes. Volume, check the strippy, nearly double normal turnout on the signal day itself, yes. 4 for 4. Every box is ticked. Now the numbers, written before anything is clicked. Entry at the signal close. Stop under the swing low. Target at the measured move from the June base. Reward over risk better than 2. The formula sizes at 21 shares. The bracket goes in, and then, nothing. A week later, price retests the old ceiling and holds it as new support. And Tom, for the first time in his life, has a limit order waiting there, sized by the formula. It fills. Days later, a shakeout dips toward the stop, and the stop never comes close. Patience. Jake, meanwhile, has decided the whole move is fake. He bets against all of it. All in short, no stop, because being right once would fix everything. Then, earnings morning, the stock gaps from 127 to 145 at the open. Mike and Tom are not even watching. Their target limits fill at the open. Your price or better, remember. Mike books $528, the biggest win of the course. Tom books $471, the best trade of his life. And Jake is forced out near the high of the day, $1,700 gone. His account is not at zero, but from down 60%, he must more than double it just to get back to where he started. And that is the plan. The checklist found it, the numbers shaped it, the bracket executed it, and the journal will remember it. One trade that used the whole course. 12 chapters ago, 3 traders started with the same $10,000 and the same charts. Here is the final scoreboard. Mike 12,778, 11 wins and a single loss. A loss that cost exactly what he planned, to the dollar. He never risked more than 1% and he never chased a price. Tom 11,080. Almost half of it came from the one trade where he finally trusted the formula. Imagine this curve if he had trusted it from chapter 1. Jakey 3,985. No checklist, no sizing, no stops, and now he must more than double his account just to get back to where he began. Same charts, same year, same starting money. The only difference was the method, and the method is now yours. Before you go, walk the road one more time. You own every step of it now. Act 1, you learn to read. A candle is 4 numbers, and the body shows conviction while the wicks show rejection. Time frames. The higher one sets the bias, the lower one times the entry. Trends, higher highs and higher lows until structure says otherwise. Support and resistance, zones where price has already shown its hand. And trend lines, the slope of control drawn through honest touches. Act 2, you learn the signals. Candle patterns, an engulfing at a level speaks, and in midair it means nothing. Chart patterns, the shapes that measure their own targets. Moving averages, the dip worth buying is the pullback to a rising line, and volume loud as real, quiet lies. Measure the turnout. Act 3, you learn to execute. Risk, the formula sizes every tradee's survival first. Order types, limit in at your level, stop underneath, target above the bracket, and the plan, trade the routine, not the mood. That is the entire language of technical analysis, and you just watched dollar by dollar what speaking it is worth. Before the goodbye, a final exam, 6 real charts you have never seen. No labels, no hints. Read each one with me. Question 1. This is Roku through the winter. Price climbs off the November low in a clean staircase. Higher highs, then higher lows, step after step. And the latest step sits just above 108. So far, a healthy uptrend. Now look at January. First, the rally stalls under the old spike high from October, a ceiling that never got cleared. Then one red day closes below the latest step, and below the step before it too. That is not a pullback, that is the structure breaking, and the aftermath proves the read. The broken shelf becomes a ceiling. The bounce stalls inches underneath it and rolls over, and the stock waterfalls another 25% before it finds a floor. When the last higher low goes, the uptrend is over. That was chapter 3. Question 2. Datadog in the spring. For 3 straight weeks, every rally dies in the same place, a lid near 118 that rejects price again and again. Then, in early June, a wide candle finally closes above the lid. Here is the exam if that breakout is real. What should the very next pullback do? It should land on the old lid and bounce. Watch. 3 sessions later the pullback comes and touches the old ceiling almost to the cent and holds. A second dip 2 days later stops a few cents above the lid and holds again. Resistance has become support. The roles have flipped, and the proof from that flipped floor, the stock runs more than 30% within a month. Old ceilings become new floors. That was chapter 4. Question 3. Intel, last winter. 2 hammers print 6 sessions apart, same long lower wick, same small body, nearly identical candles. Do you trust both, one or neither? Location decides. Look underneath the first one. Its wick stabs into a floor the chart has defended again and again for 2 months. Buyers kept defending it near 21. A hammer at a tested floor is a real signal, and the market agrees it launches more than 20% in 4 sessions. Now the twin. 6 sessions later the same shape, but it floats in midair, far above any tested level, after a vertical 3-day pop. Same candle, nothing to stand on, and it collapses 10 sessions later. The price has fallen all the way back to the floor it ignored. The candle is the word, the level is the sentence. That was chapter 6. Question 4. Palantir in the fall. Drifting under the all-time high for weeks, then in early October a close above the entire September range, within $1 of the old peak breakout. Do you chase it? One habit first, check the turnout. Look at the strip. That breakout close came on barely 7/10 of normal volume, a new high that nobody showed up for, an empty room, and the market grades it instantly. The very next session the breakout collapses 7.5%, straight back inside the range. And for the rest of the month, price never closes above that level again. Loud moves are real, quiet moves lie. That was chapter 9. Question 5. Micron has spent months above a rising 50-day average. Every close above the line all fall. Now price has pulled back and touched the line a second time. Is that a sell signal or a buy zone? Read the history first. The first touch, back in November, was bought back above the line the same day, and the bounce ran 11% in 2 sessions. The line has been defended once already. A pullback to a rising average inside an uptrend is a buy zone, not a crime scene, and the second touch proves it. The candle closes back above the line. The next day buyers step in on heavy turnout, 2.5 times normal, And 12 sessions later the stock is up more than 50%. In an uptrend, the rising line is the dip worth buying. That was Chapter 8. The final question, and it is the whole course. Costco, this winter, one ceiling has rejected price 5 separate times over 2 months. Yesterday, a candle finally closed above it. Today, price dipped right back to the old ceiling, and it holds the level. Build the plan out loud. The checklist: a proven level, a fresh breakout, a retest that held, and the turnout on the bounce day was quiet, which here means no sellers showed up to fight it. Now the numbers. Entry: the retest close, 941.93. Stop: under the retest low, 925. Target: twice the risk, 975.79. Size: 1% of the account divided by the distance. The bracket goes in. Hands off. 6 sessions later, the target prints, and the trade never once came close to the stop. That is not luck. That is a checklist, a level, a signal, the numbers, and the patience to let them work. You can now do this on any chart in the world. Course complete. Welcome to part 2 of the exam. 7 more charts, slightly harder. Question 7. Caterpillar through the winter. I have drawn nothing yet. Find the structure yourself. 2 swing lows, October and November, line up perfectly. Connect them and you get a rising line, the slope of who is in charge. Now mid-December, a scary, full-bodied red candle falls straight into that line. Panic says sell. The line says this is the third touch. Look closely. The wick kisses the line and stops, and the body closes 4 points above it. Buyers defended the slope exactly where the line said they would. And notice what makes a touch honest: the wick may pierce the line, but the body must finish above it. One body closed through the slope and the line is dead. That single rule keeps you out of every broken trend. The read: a rising line with 3 honest touches is a buying spot at the line, stop just underneath it. And the aftermath grades the read. The bounce is immediate. 3 green sessions in a row. And the stock never looks back. 13% in 3 weeks, and more than 40% above that third touch by February, without a single close below the line in the entire window. Trend lines are not decoration. They are where the trend defends itself. That was Chapter 5. Question 8. Walmart in the fall. Price sells off to about 100, bounces, and 6 weeks later sells off again, into the same neighborhood. The second low actually undercuts the first by about 1%, and that undercut is the honest part. It scares out the early buyers right before the turn. 2 lows, 1 bounce between them. You are looking at a W, a double bottom. Now the math from Chapter 7. The bounce high between the lows is the neckline. The pattern's height is the neckline minus the lower low, $10.70. In late November, a candle closes above the neckline. Breakout. One warning before you trust any neckline: the close is what counts. Wicks poke through necklines all the time. Only a full daily close above it turns the pattern on. Project the height up from the neckline, and the pattern measures its own target, 120.28. And the market pays the pattern in full. Price never closes back below the neckline, not once, and 30 sessions after the breakout, the target prints to the dollar. Patterns are not pictures, they are measurements. That was Chapter 7. Question 9. Coinbase in July, 75% off its spring low, and today it punches to a brand new all-time high. Everyone is excited. Before you join them, read today's candle piece by piece, like Chapter 1 taught you. The open and the close are 4 cents apart. The body is 4 cents wide, on a day with a 38-point range, and the upper wick is 25 points, 2/3 of the entire day. Now translate: buyers pushed price 25 points higher, into the most optimistic price in the company's history, and sellers shoved every single dollar of it back down by the close. At the very top, conviction completely failed. That is a gravestone, a candle that says the party ended on the top floor. Compare it with the candle that started this whole rally back in June, a giant green body that opened on its low and closed on its high, nearly all body on 4 times normal volume. That is what conviction looks like. Today's candle is its exact opposite, and the aftermath is brutal. The stock never trades near that high again. It bleeds for 2 weeks, gaps down, and lands 29% lower within a month. One candle read properly called the exact top. Body equals conviction, wick equals rejection. That was Chapter 1, and it never stops mattering. Question 10. Caterpillar again, 6 weeks after your trendline trade, and something scary has happened. The worst week in months, down more than 8% in 5 days, and Friday gapped lower and closed on its low. The daily chart screams top. Do you sell? Not yet. First, you change the clock like Chapter 2 taught you and read the weekly story. The January pullback made its low first. The next pullback bottomed higher. Higher lows every time. The weekly ladder is intact. So the only question that matters is whether this scary week broke the last weekly low, the line it had to hold. Look, the entire pullback bottomed 5 points above that line. Scary on the daily, routine on the weekly. The read: the higher time frame sets the bias, And the bias is still up. This is a dip inside an uptrend, not a top. This is why Chapter 2 told you to pick your clock before you pick your trade. The same 5 days are a catastrophe on one clock and a routine dip on another. The chart does not change. Your distance from it does. The aftermath: 5 weeks later, the stock closes back above its old high, and by the end of April it prints a brand new all-time high, a third higher than that scary low. When the daily frightens you, ask the weekly. That was Chapter 2. Question 11. Coinbase again. And if you remember question 9, you know how this chart got here, the gravestone top, then the collapse. But watch what happens at the bottom. August price stabs down into one level and closes back above it. 2 weeks later, the exact low of the move, a hammer, closed back above. Early September, a third stab, closed back above again. 3 stabs, 5 weeks, the same 0.5% zone, and not one single daily close below it. That is not luck. That is a floor being defended, purchase by purchase. And read the wicks at each stab: long lower tails every time, with the close finishing far above the low. That shape, repeated at one level, is buyers stepping in front of sellers on purpose, at a price they chose in advance. The read from Chapter 4: a floor proven 3 times is the entry. You buy the third rejection at the floor, stop just under it, and let the level do the work. The aftermath: 2 sessions later, the bounce is confirmed. 9 sessions later, the stock is up 20%, on more than double the average volume. The one pullback along the way bottoms above the floor. The stop never blinks, and inside a month the bounce is worth a third of the account it was sized for. Floors are where buyers have already shown you their hand. That was Chapter 4. Question 12, and this one is pure arithmetic because sizing is the chapter most traders skip. Airbnb in May, a rally to 139, then a pullback that finds buyers at 125, to the penny. Today's candle retests that exact level and closes strong at 129, with volume behind it, 1.6 times normal. The setup is valid, a tested floor, a strong close, the turnout confirms. Now the exam: your account is $10,000. The stop goes $1 under the structure, 124. How many shares do you buy? Walk the formula. 1% of the account, $100 of risk. Entry minus stop, $5 of risk per share. 100 divided by 5, 20 shares. Not a guess, a calculation. The target is the old swing high, about 2 times your risk. Good math, and notice what the formula quietly did for you. It made the trade survivable before it ever became profitable. If the floor had failed, you lose $100. Annoying, recoverable, planned. The formula cannot pick winners, it guarantees survivors. And the trade: the worst the market ever does is a dip to 127.99. The stop never even gets close. And 5 sessions in, the stock gaps through the target. 20 shares, nearly $11 each, more than $200 banked for 100 risked. The formula is the trade. That was Chapter 10. The final question of the entire course, and it is the most important one. Salesforce, this spring, the stock has crashed from 267 all the way down to 174 in 7 weeks. Today, a big green candle, up 3.5%, closing above the bounce high and above the round 200 level. A breakout candle over a level. Tempting? Run the whole checklist before you answer. Trended price is far below a falling 50-day average, and the average is dropping more than a point per day. Strike 1, the highs each high lower than the last all the way down. Strike 2, volume barely average, nobody is behind this. Strike 3, 3 strikes against one pretty candle. The checklist says no, skip it. Skipping is a trade, and it pays in money you did not lose. The rally tops out less than 2% higher, rolls over within a week, and then breaks to a brand new low, 19% below that tempting close. Anyone who bought the breakout rode it all the way down. You did not, because you asked all 4 questions instead of 1. So what would change the answer? Patience. Let the falling average flatten and turn. Let price build a floor and hold it. Let one rally finally print a higher high. When those appear, the same green candle becomes a real signal. Until then, the winning position is none. And that is the entire course in one sentence. Anyone can read a candle. A trader reads the whole chart. Congratulations. Final exam complete. And that is the complete beginner course. 12 skills, 1 language, and 3 account curves that show exactly what the habits are worth. Your homework: before anything else tomorrow, pick 1 liquid stock, open its daily chart, and run the question 13 checklist on it out loud. Trend, level, signal, volume. 4 answers, then a decision. Do that every day for a month, and you will be ahead of most people who have traded for years. Next up, the intermediate full course: market structure, supply and demand, and the setups professionals actually trade. Subscribe so you don't miss it, and drop a comment with the chart you want broken down next. See you in the next one.